Oh, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday and it's the 29th of October 2021. Today we want to look at a very interesting topic. We want to talk about cognitive biases and how these negatively affect your trading performance. And not just that, I also want to give you some thoughts, a plan, let's put it that way, how to avoid them or at least reduce the impact these cognitive biases have on your trading. If you're surprised, by the way, to see me a little darker than usual, that has to do with the fact that the sun was straight lighting here, straight shining onto my desk, and I just had to find a solution for. So don't be surprised. So if you watch this now on YouTube, if you watch the recording, please feel free to share it wherever you can share it on social media. If you have any thoughts, any questions, please feel free to share them right below the video. Ask them in the comment box. If you like the webinar, leave a thumb up here, subscribe to the YouTube channel, set a reminder so that you don't miss any of the webinars which Paul, Marcus, and I are producing here for you in your trading. And make a long thing short, let's jump straight into the action and give some deeper thoughts and details, especially here on today's topic. So on the topic on trading psychology and how cognitive biases negatively affect your trading performance. By the way, let me just try something. Whoop. Good. Yeah. So before we start, let me just here give you some insights. You probably have already seen it, but if not, there was a rebranding, or there's currently a rebranding taking place. So Admiral Markets is now Admirals, and the reason for this rebranding is very simple. So Admiral Markets is still in the FX and CFD business, and is probably one of the most renowned and well-established FX and CFD brokers around the globe, with over 8,000 financial instruments being available to trade, a classic multi-asset broker, and has a global presence with local languages here also around the globe, fully regulated broker, SISAC, FCA, ASIC. So also now new, it's a Jordan, that will be the next slide, by the way, and a very competitive offering. So I myself, I'm located in Berlin in Germany. And when we talk about Admirals or Admiral Markets, then we usually talk about the probably best, most competitive, at least, broker here when it comes especially to DAX trading, but also when it comes to FX trading. And now that's it around the broker. And now there's the rebranding taking place, and there's other further financial services which are provided in the future, like a wallet where you can exchange, for example, your money, exchange your money, respectively your account balance, into a gold wallet, for example. Probably rather sooner or later there are plans to switch this also to the crypto space. Probably some of you have seen the developments there in the overall market, and here Admirals has also some interesting developments and plans in the pipeline. You can also, via the SISAC regulation, get your hands on a credit card from Admiral Markets. So to put it simply, a little blunt, make money in the markets and then spend it with your credit card. Probably on Amazon. You've seen yesterday's earnings, and they weren't that strong. In fact, well, they weren't that strong. There was the very positive numbers from the cloud computing business, but everything else didn't look so promising, to be honest. But let's keep things short here. However, so this is the main reason for the rebranding, which takes currently place. And for further details, please check out admirals.com, respectively admiralmarkets.com, and get some further thoughts here on this. One world, one broker. I already mentioned it, at least between the lines. There's now a fully regulated brokerage license here also from Jordan. So also all the information available on the website. That's it around the introduction. Now let's have a look here at today's agenda. First of all, I want to give you an introduction to today's topic, and what's probably the main reason, the main driver for the presentation of my thoughts here, and why this is of such high importance, especially here the aspect of trading psychology. I then want to share with you some thoughts on the 4 steps of learning. In fact, oh, I'm sorry, no, it's that's a little unfortunate. I just realized, no, it's more like it's like an introduction to behavioral finance. I'm sorry, that's not very good. I'm sorry. No, this is the wrong agenda. I just realized that it's the wrong agenda. That's one step further. Yeah, this is one of the upcoming webinars. In fact, I prepared here, so I'm sorry. So the next slide will be the 3 columns of profitable trading, in fact, and then also what behavioral finance has to do with this. So this is what we want to look at here, and then I want to play a game with you. So to illustrate this concept of behavioral finance, respectively loss aversion, especially, so that we are all affected by this. And then, to make long thing short, at the end, I want to show you how to profit from this knowledge. So it's interesting and exciting at first glance that we are all, let's call it, victims to that. But what's of higher interest is probably how can we avoid this? Because if this is such a strong force within us and is affecting our trading, especially in a negative way, then certainly we have to find ways and solutions to overcome this. And so let's first of all start here. Just ignore the agenda before and focus here on the 3 columns of profitable trading. So you probably have heard that profitable trading has a lot to do with solid risk money management plan. So not risking too much per trade, but on the other hand, risk enough so that it makes an impact at least, and that you see a growing capital or equity curve in this context, and but keep drawdown small so that this rising equity curve, which you're trying to achieve by trading a strategy with a positive expected value here, will result in a very smooth upward trend, let's say. You have also heard that profitable trading has a lot to do with trading psychology. So some probably go as far to say trading is 100% psychology. I know what someone wants to say with that phrase, but still I'm not very confident whether this is, or sure whether this is still true. Or, I mean, I understand it, but I think you can be the mentally most stable trader in the world if you do not know what you're doing, respectively, if you don't have an adequate risk money management plan, risk too much per trade, can handle the swings because you're mentally stable or your bankroll is big enough, you still won't make any money and won't enter the world of profitable trading. So, and that's definitely something to consider, which is bringing us, in fact, straight directly here to the 3rd column. It's trading strategy with an edge in this context, which you have to find for yourself, formulate for yourself, which has to correspond with you as a human being. And all these 3 columns in combination with each other and strongly interacting with each other. So even though you might say, well, if one is missing, I'm still an expert on, let's say, risk money management and trading strategy with an edge, I don't need to be mentally stable, let's say. I still have the knowledge. I have the confidence that the strategy works. So sometimes I might face any bigger issues here that I'm probably have to bite my fingers or have to sit on my hands to not click and exit the market. But at least I'm fine to continue to trade here the profitable trading strategy and make money. So in fact, that was the thinking, that the thought process of a student I had in the past. And I told him, well, this won't work, believe me. So, and he said, well, I don't agree with you, because he said, well, if you give me a strategy which works and I see it works because you traded yourself, isn't that then that I just can't trade the strategy itself? I said, no, it won't work because you don't trust the strategy. There will be times you just not interact, you interrupt the trading, or you just say, well, I don't trade the strategy anymore, I can't trust it because now I have 4 losing trades in a row. So a personal anecdote based on that is, in fact, that I told him there was a time where I had a live trading event series with a broker, and also in the English-speaking world. It's years ago, and they said, well, I'd really like to see you here perform in front of our clients and trade with them. And so the thing is that I did exactly that. I presented the strategy. One you probably have heard about. It's on the trading the S&P and the open range breakout here around the market opening during Wall Street. And you know that the strategy is profitable because I presented the key parameters of the strategy to them. Still, the first 4 events were unprofitable, or unprofitable meant I lost money with trading the strategy in front of them. So that means that the event was taking place every Thursday. People were tuning in, looking me over the shoulder, seeing me trade the market based on these parameters, respectively the strategy. I lost money. Well, the first time there were 200 participants. Next week it were only 150. The week after we were only 100, and then we came in at around 50. The fourth time I lost, and then we stabilized around 30. The funny thing about this was that I was way ahead during the month, because the strategy itself had a very nice run from Monday, Tuesday, Wednesday, and Friday. I only lost, in fact, on a Thursday. I made money with the strategy, but the people were just seeing this one instance where I lost money with trading the strategy. And that being said, perfectly illustrates and explains why it's so important not just to get a strategy, hands on a strategy which is potentially profitable, but in addition to that, also understand the strategy, probably have thought about it yourself, have worked it out yourself, backtested it, and just build a certain level of trust, which you can then use to build your trading career on. And this is definitely something to keep in mind here. And that means that even if you might have such a strategy, if you're not mentally stable, and trust is one aspect of being mentally stable, it will be very difficult here to trade the strategy, or the other way around. You can be mentally stable, as I already pointed out, but still risk too much in a profitable trading strategy you might have, because you're greedy or whatever, you're not mentally stable, resulting in you losing money in the long run. So long thing short, you have to be an expert, and you have to deeply study each column and see how these columns interact with each other. And there's a reason why now the middle column here in red is, or the middle column trading psychology is red. The reason is because this is the aspect we want to look at today, at a specific topic within this column. And we look here today at something we know as behavioral finance. So the first question is, what is behavioral finance in this context? And there's in fact a Wikipedia article. Let me just share it. Probably I haven't opened it, by the way, here in the background. Let me just see. Behavioral finance, or it's probably under behavioral economics. That's also possible. Let me just see. So this is a German article. I want to have it in English. Yeah, it's behavioral economics. So don't be surprised to see it. By the way, one sec. So I call it Wiki, okay? It's for the Wikipedia article for further information on this topic. It's a very broad topic, and we only want to pick one piece here out today and make it a topic to give you an idea on, for example, why it's so difficult to let winning trades run and cut losing trades short. One second, I just have to see here one thing. Probably it's the best time now to say it right now. So in fact, we prepared a survey here for you. And after the webinar, what you will see is there appears a quick survey. And the survey wants to cover, it wants to know, in fact, so we want to know what people think of the webinars in general. So not just this one specifically, but also all the other webinars we're holding here. And it's a chance for us to grow, to get a feedback from your end. And so the thing is, it's automatic. So that means you don't need any links or something like that, but it will just appear in front of you. And then I'd really like, or I'd hope that I'd really appreciate, would really appreciate if you answer the question quite quickly. So probably 3 minutes, not more than that. And so that being said, don't be surprised if you see the survey. It really helps us to grow and to deliver webinars, not just at a high level here, but also in addition to that, make sure that we present topics to you here, which you are interested in, for example. And so yeah, that being said, let me just, by the way, let me just check something else here in the background if everything's cool. So that's very interesting. So what I do now is, by the way, I prepare my intraday trading with just getting some numbers. And it's very important to have these numbers, and you will see why. So the interesting thing is you probably not here for the first time, and you've seen that every Friday, or also on Wednesday, next Wednesday, for example, I give another crypto webinar on Bitcoin, that I have to check some numbers. I have to write them down before the market opens, to be prepared, well and good prepared for the trading day. And this is one step here, one very significant step to reduce the so-called cognitive biases we want to talk about right now. So it's already giving you some ideas on why this is so important for me, because it helps me to avoid jumping into the action where probably there is no action, where I can't duplicate potential success, or where I can't really find out why the trade didn't work out as it should have worked out. And so the thing is that I'm having these routines, respectively, these numbers every day, every time the same, available for your trading is crucial, in fact, for long-term trading success, given the fact that we are emotional subjects, that we're human beings. And this is to some extent already what this webinar deeply covers, and why it's so important, and giving you already a practical approach on how to avoid these these biases, or these cognitive dissonances in your trading. But first of all, what is behavioral finance about? Let's first of all start here. So if you read a book, it doesn't really matter which book it is. What you will read is that the overall formula to be long-term successful in your trading is let winning trades run, cut losing trades short. That's it. And it's true. That's it. I mean, it's really true. The only problem is we know this, and it doesn't really matter which books you may have read on trading. It's so difficult to achieve that. And there's one simple explanation why this is the case. So the exciting question is, why don't retail traders just follow this very easy saying and do instead what they do? And what do? Well, they cut winning trades short, and they let losing trades run. So, and that being said, brings us here to what we know. So psychology in trading plays a crucial role. And here emotions certainly play a very important role. And this is something also, I mentioned this already at the beginning, or respectively between lines at least. So the agenda didn't really fit what we are covering here today, but there's a webinar which you can put on top of this webinar and get one step further. And so emotions here, I really know what someone wants to say if he says, well, don't let emotions interfere with your trading. That's definitely true. Try to avoid emotions, especially negative ones. But there's also positive emotions. And again, it's not just that there's a differentiation between positive and negative emotions, but there's also one crucial aspect we should consider, especially once we trade discretionary. So once we sit in front of a screen and then decide whether we want to buy or sell at a certain point, or enter a position, exit a position, we're human beings. And as human beings, we are emotional. That's just what we are. That differs. That makes the difference between us and machines, for example. Okay, so, and it's nothing to be, well, feel bad about or something like that. It's just, this is what we are. This is how we are, and who we are. We are emotional. And so that being said, brings us to one important aspect here, because these emotions, obviously they play a very crucial role since we're human beings, and you can break them down to anger, frustration. For example, if a trade doesn't work out as expected, you can break them down to fear. So I fear to miss the action. So just look at the well, I don't know, probably not the Bitcoin chart, but probably have seen what's going on in how's it called, Shiba Inu, something like that, some crazy crypto hype, where I think that what I just read was that there was a wallet which bought something like 8,000 USD worth of Shiba coin, something like that, around half a year ago or so, if I'm not mistaken. And given the recent price action, this wallet now, this investment, let's call it investment, is now worth 5.4, 5.7 trillion. No, trillion, is it right? No, billion. I'm sorry, billion. Trillion, that's probably a little too much, but a billion USD. So Not really sure whether this is fake or not, or it has been played up and down in the social media and on Twitter, on FinTwit. Probably have seen that. And now the thing is, you now look at the chart and say, well, this sounds great, no? So I have to jump into the action, or also I have to jump in, probably bring this down to a little lower level, say, hey, I need to own Bitcoin for whatever reason. Might there's any kind of news around this, you came across, like inflation fears hitting, probably USD will lose its status as a world reserve currency, and you don't want to invest in gold, and whatever reason that might be. So fear of missing out, or the fear that you just will lose money with the trade. Simple. So you enter the market, and if you have kind of a strange gut feeling there, that might be because your position is too large, one reason, and you just can't afford to lose this amount of money. So you have fear in this moment. Self-confidence, ego. So just you imagine you just went long, let's say Bitcoin around 30,000 USD several months ago, and now here we just pushed to new all-time highs and above 60,000. You doubled your money within a short period of time. You think you're the greatest trader alive. It was just a one-way street, so you didn't really need to do anything about this. There were no real big trade decisions to be made. You can look at a lower time chart, a lower time frame chart. You will see that's just a sequence of higher highs and higher lows, just taking off from there. And the thing is that this still triggers some emotions. You think you're the greatest. And there's then this ego component. Self-confidence is growing, which could lead you to take risks you shouldn't take, or you wouldn't usually take under, let's call it, normal circumstances, or once you're not that emotional. You're motivated to do something. There's some kind of taking action. You have to take action. This is triggered by something which we learn in school. So if you come home to your parents, remember these days, and show them that you just have a bad mark in mathematics or in whatever, and they say, well, what can you do about this? Simple, learn. Okay, great. So do more, and then get a better mark in school. So work out harder, go to the gym in this case, work more, and get a nicer body, and be the star of the beach next summer. It sounds ridiculous, but the thing is that in trading, it's the complete opposite. It's not more what makes you more success, but it's more like be more selective and focus, especially on the process here, on trying to grow, find areas where you underperform, tweak these areas, and then try to improve based on that. But this is not just do more. So if you lose money trading the market, it's not possible to trade more and then make all the money back and even more than what you made back to be profitable for the month. If there's no spot where you can be trade profitably, you have to wait, you have to sit on your hands. And so all these emotions, you have to do something. You probably haven't traded for a while, but and then jumping in and into the action and be on marginal, let's call it marginal plays, this will cost you money in the long run. All this is triggered by emotions. And we don't want to focus on all of these, because mainly the main, and based on my personal experience, the main emotion we focus in our trading is in fact fear. So fear is the main topic, in fact, fear of missing out, fear of losing money. And the thing is, based on these emotions, once they are triggered, and you're driven, your decision-making process is driven by these emotions, then you get to see something we remember, or we know as so-called cognitive biases. So, and this is the key aspect of behavioral economics, respectively behavioral finance. So cognitive biases, what they are is they are systematically and flawed tendencies when it comes to perceptions, remembering, thinking, and judging, which impacts your trading in a negative way. So this is what it is. So once you're emotional about something, you tend to, for example, give one outcome a higher chance than the other, even though from a statistical standpoint, it doesn't make sense. Usually what I usually do here in this context is I give the example from 2016, the election from Donald Trump. If you ask someone, let's say in May or in June, especially after the Brexit took place, probably this is the reason why we should ask him in May, because this was already a big surprise. And you can, I have videos back then, so I can't really say I didn't expect, or I was the complete opposite. I expected the Brexit to happen, for example, or I expected Donald Trump to be elected this year. The thing was, I wasn't. Right the day before the Brexit took place, I knew that this won't happen. I knew knew based on just the puzzle pieces I put together, and just said, no, this won't happen. The interesting thing about was, well, we saw the Brexit vote, we saw Donald Trump being elected. If you ask someone in May about the likelihood that, for example, Trump gets elected in November 2016 and become the, I think, 45th president of the United States, someone would have said no chance, probably 10%, if at all. Ask him the same question then on the 10th of November 2016. 9th of November, 8th of November, if I'm not mistaken, that was the election. Ask him the question again. The same person will tell you, well, it was clear. No question. Oh, well, I mean, certainly. I mean, look, all the developments political wise, which are taking place. So, and you ask him, okay, which likelihood do you think you gave a win of Trump in May, half a year ago? And he will tell you something like 50% minimum, probably 60, 70% probably. So, and this is, this is what we call hindsight bias. This is the same. Now we might wonder, okay, what has this to do with trading? It has a lot to do with trading, because this is exactly what happens once you say, well, market is long. I knew that. Well, if you knew that the market is long, whatever it might be, Bitcoin, DAX, EURUSD, whatever, well, why weren't you long if you knew that for sure? Because you didn't know it. That's you didn't know it. That's just as simple as that. Because you thought it would rise, and once you look at the chart, you see the chart rising, and that's the reason why you think it was clear that it would rise, but you weren't that sure once you saw the price action, presenting whatever picture and taken from there. It's also now in terms of, let's call it all the developments around coronavirus, and I think it's a global topic right now about vaccination and potential side effects and all this. Whatever you think about this, the thing is, you have to take a step back here and understand that you're probably underlying a heavy cognitive bias in this context. It's a very emotional debate we currently face in our society in general. And it's not just Germany, it's around the globe. Everyone is very, very emotional. So chances are massively elevated that we see cognitive biases all over the place. So if you now say, well, there are side effects once I get vaccinated, you certainly will look for data, respectively pieces in a newspaper, which will underline exactly that and confirm your thesis here. That's what we call confirmation bias, for example. The same is true when it comes, for example, to calculate the likelihood that such a side effect comes into play. And no one says that there are no side effects. This is definitely not true. But if you look, for example, on how many doses from vaccine XYZ were given to the population, and then the side effects, and you see the likelihood of a side effect taking place in this one patient, then, for example, it's minimal. It's a very, very, very low probability. That doesn't matter. It's not it does not have a severe impact or something like that. But this is also true. For example, when I went on honeymoon with my wife, that was in 2015, yeah. We went to Bora Bora, so very, very nice place to go. And the thing was that 2 or 3 months before we went on the airplane, there was a big incident here in Germany. There was a school class which were coming home from a school trip from Spain, and there was a mentally unstable pilot or co-pilot, and he crashed the plane, and the class died. That was a big story, and it's devastating. But the thing is that you look at this and you think, oh my gosh, if this happens to me now, everyone can understand that, but it's triggered by emotions. You look at this and you just think, just imagine my kid would have been on this plane. I mean, this triggers emotion. And once you're in this state and emotions are triggered, you think about this statistical, how can I say, unlikely event taking place in a completely different way, and you overweigh the chances of it to happen. And now coming back to trading, we are in a very, very emotional state once we sit in front of our screen and trade the markets. We all know this. Once you open the market or the platform, trading platform, and now, as right now, for example, Wall Street is opening and the ring bells, and now the action is taking place and the charts is going berserk, let's say, and it's moving up and down, you start to jump into the action and get emotional. And that directly affects your way of thinking about one event happening over the other, for example. And this is something we have to be aware of, and then find ways how to filter out the noise, we can call this. So now the thing is, sounds interesting, probably very fascinating. Some of you might well say, well, great, nice. But have you some further details on this, or can you explain this? Or, well, first of all, it's something which we can see in the market. This is a chart which compares average winning trade of losing trade. It's a very big sample size, in fact. So what you can, first of all, let me just explain. So in blue, you have the average winning trade and the average losing trade. And the time span we look at here is between April, just one second, 2013 till 2014, if I'm not mistaken. It's a third-party broker. It's information I found for myself, I work with for myself. For example, here we have EURUSD, and within this time span, we have an average winning trade of 22 pips, while we have an average losing trade of slightly above 40 pips. So it's a 1-to-2 ratio here. And when looking at EURUSD alone, so you have also gold, you have here the DAX, and so on and so forth. EURUSD in this context, this is 9 million trades and more, where you can see this pattern to happen, in fact, how retail traders behaved during this time span. And this is very interesting, because this is real trading behavior from retail clients. And what you can see here is, once someone tells you that a retail client has trouble to let a winning trade run and cut a loser trade short, this is exactly what you can see here. So the average winning trade is smaller than the average losing trade. And now you might say, okay, great. We could end the presentation here. I could just say, okay, now you have seen it, cut, and just be aware of that, find ways how to deal with that. The thing is that this is not getting the job done. What I want to do is I want to play a game with you now. And I'd really like you to answer within the chat box. By the way, all the guys, I'm watching this now on YouTube. I invite you, write down your comments and what you think about the game, and which choice you made, in fact, and be honest to yourself here, because this can already show you that it's human. There's no right or wrong, but what you will see now is that there's a psychological effect you will see. And so we play two games, okay? So the first game is two options, A and B, same for the second game. And then what we will do is you choose an option, A or B, okay? So let's assume the following. Game one, choose one of the following two options, okay? So first of all, option A, you're right here getting 900 euros from me. Everyone sitting here in this webinar now, sitting in front of the screen, watching the recording on YouTube, gets 900 euros. You get 901 euros if you give it a like, thumb up. No, okay, so 900 euros, okay? Option B, you have a chance of 90% to get 1,000 euro, but a 10% chance of getting nothing at all. So it's like as if we didn't play the game. So now you have to choose A or B. Which option do you choose? And I'd invite you to write this down now into the chat box. So the first one here from Gertz is already. So we have A and B, and so on and so forth. Let's see. So 3, 4, 5. I count, by the way, here how many already voted, so that it's easier to calculate than the ratio. Okay, A. Once again, so we have 8 now, 7 A's and 1 B, if I'm not mistaken. I think there's another A. And another A, and a B. So now I think we have 10, no? 10, 8 A's, and 2 B's. First of all, very important, there is no right or wrong as an answer. And you can calculate this yourself. There's a formula behind this. It's called expected value. Okay, you have 1,000 euro. And if you multiply 1,000 with 90%, you get 900 euros. And then you subtract 10% multiplied with 0, so 0. So it's 900 euros for B and for A, expected value, because in the first option here, you get 900 euros. Okay, so mathematical wise, there is no right or wrong, but you clearly choose A over B. If you look at the numbers here, you see there's an overwhelming ace, which you can see here. Okay, so that's interesting. That's interesting. Let's play the second game and then take it one step further. So game 2 now is my game. You lose right here and now 900 euros. Everyone sends 900 euros to me. That's the first choice, A. Or second choice, option B, you have a chance of losing 1,000 euros in 90% of the cases, or you don't lose anything at all. 10% chance to don't lose anything at all, and just we just imagine this game has never happened. So which option do you choose now in game 2, A or B? Oh, none is, by the way, none is not an option. So B, 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 B. Is there someone who would choose A, B, B, B? So overwhelming B. I mean, even if there's no one saying, okay, I take A, everyone would agree that now B is overwhelmingly taken. So now let's have a look at the games. There's a big difference between these two. In fact, it's the only difference, but it's a big difference. The first one is winning. You win 900. And the second is you lose. The first, you say, I take the safe bet. I'm not gambling. In the second, in the losing case, you say, let's gamble. Because if I lose 900 or 1,000, doesn't make a difference, no? But at least I have a 10% chance of not losing anything at all. Now, coming back to trading, what do you learn? Let winning trades run, gamble on the potential gains and let them run, try to make more, but be strict when it comes to losing, cut them short. So again, mathematical wise, there is no right or wrong. It's a purely emotional based decision you take. The first one, you decide in the case of winning. The second, you decide in case of losing. So even though that game might have some, let's say, glitches or something, or some might probably argue, well, is it really illustrating this loss aversion concept? I think it does, even though certainly we could probably adopt it. Some might probably argue, well, for someone right now in, I don't know, in a state where he says, well, I need 900 euros so bad because I want to buy my wife a nice ring, or I want to I don't know, buy my husband a nice trip on a road track or something like that, with a nice car, whatever, racetrack, with a nice car, whatever it might be. But the thing is, obviously, you're taking a different decision when it comes on winning and when it comes on losing. And we see it here in the chat box, so you can see the answers yourself. And again, there's no right or wrong. It's just a decision you take based on being a human. Simple as that. And so now I held this presentation, or I played this game here in front of an audience. It was in Munich. It was something like 10 years ago or so. And there was one attendee who came to me after the event and said, well, Jens, the thing is, I'm not really sure if people really see here the parallels between this game and trading. And after thinking about this, I had to agree. I'd say, yes, probably this is kind of abstract, in fact. And so I'm constructed here this chart, in fact. And so what you see here is a sequence of higher highs and higher lows, an uptrend. And now let's guide us through the thinking process once we enter a position with a break to new highs. Let's just assume we say we break here to new highs. This is where we enter our trade, and our stop is here below the last relative low. So this is where the purple ellipsis, this is the entry for a long position. And then we have the losing point. Now we see the market moving straight away in our direction. It's a dynamic breakthrough on the upside, breakout trade, whatever we might call this. And this is the phase of gaining profits here in this trade. And then you see for a sequence of higher highs and higher lows to develop, you need to see a pull in and then the market to mark a higher high in this case, and then turning around again and taking out the former highs and then continue to build the sequence of higher highs and higher lows. So what you now see is that here in this moment, the market pulls in. And then there's a point where you just say, well, what if now we drop and I'm getting stopped out here? That would be very, very bad because I already saw some nice, even though unrealized, but still gains. And the pain I have to take here is really like you're not really sure about the trade anymore. So what you do is you say, okay, at least I have a small gain. I take it out the trade here, and I can't take the pain anymore. In addition to that, I can easily enter the game again, the trade again, if we now hold these highs or something like that. Again, there's nothing wrong with this. There's nothing wrong by taking partially profits or something like that, but it underlines the natural tendency that we try to make a profit based on our emotions and completely leaving out that in case of the market here seeing a fake out and then dropping from there, that we probably tend to take out the stop here because we are so convinced that the trade will play out based on our thesis, that we say, well, this is, first of all, here the loss, this is our initial stop loss, if you had one, or you had a hypothetical stop here at this level, it was just a mental stop, and you say, well, even if we drop now lower, well, all in all, the market will turn around rather sooner or later, and then take on momentum from here. So now you realize, based on the emotional pain you take here, you take a small gain and not letting the market play out on the upside, continue to play out on the upside, while you start to gamble with potential loss if the market here sees a fake out and then rolls over against this region. So this is the idea behind this. And as we've seen in the game before, I think fairly good illustrated, this is natural tendency of human beings in general. And this is bringing us then to the so-called 4 cases of loss aversion in trading. I'd like to recommend you one book here. It's Thinking Fast and Slow from Daniel Kahneman. It's probably the best book on trading you will ever read. And by the way, I was talking about the honeymoon with my wife, Thinking Fast and Slow, Kahneman. I read the book during our honeymoon. So because it's just fascinating. It's a really, really good book. It's not just on trading related, but once you read it, you will see that all these emotional developments you face during your trading are described within this book. And then after reading the book, you have a good understanding of why you behave the way you behave. And this table here can be found here, even though it's one which I adapted to trading here, but this table can be found within the book Thinking Fast and Slow from Kahneman. And so what we have here is a case of winning, a case of losing, and then we have the so-called high probability, the sure bet development, and the low probability, the risky bet. And so in the case of winning, I have here an example: 70% chance of winning another 1,000 euros. And then you have the fear of disappointment in this context, and losing here results in taking profits quickly instead of going for a profitable trade, respectively bet in this case, and hope that there will, for example, a breakout occurring. One way to overcome at least partially, is to take partial profits. So for example, if you see a strong move, let's say US equities, for example, in the stock market, you see a market seeing, let's say you come to the conclusion that after yesterday's earnings in Apple, for example, let's take them as an example, they were disappointing, at least in my personal opinion, and I'm now formulating a bearish bias for today. And I see the chances of a strong bearish opening drive, for example. Wait, let me just see. Did we see that? No, it does a Starbucks. One sec. Let me just see what happened. That didn't happen. Unfortunately, didn't happen. But we were all over. Okay. So 148 was another level, and we're rolling over against this region, and now we're going for 146. But let's assume we see this strong opening drive on the downside. Then we could say, okay, I am built a position, let's say with 100 shares, and I take after the market moved 1 ATR, for example. So you have to quantify that somehow. You take partial profits like 25%, 50%, something like that. Not really sure. It depends on your risk parameters, respectively, the numbers you profitably trade with. Let's put it that way. So this can overcome here your overall loss aversion, at least to some extent, because now you already booked some profits, and this is somehow calming your mind. And so you can stay within a trade and then go for a break higher, for example, and believe in it. And even if it doesn't happen, well, you can still say, well, I at least made some points on the trade, some money on the trade. So then there's another case of winning in case of the low probability bet, for example. And this is one we take far more often than we think. It's the 5% chance of winning 1,000 euro. It's the lottery principle, we can call this. So it's the hope to get lucky. So to strike the home run, waking up on the right side of variance, we can also call this. Nevertheless, the thing is, while we are fearing here to take a high chance, and so you can see that 70% chance of winning another 1,000 euros, this equals expectancy-wise, it equals to 700 euros, while here in this case, we are only talking about 50 euros. So while we take here this lottery principle more often than we think, here we fear to see the breakout not happening, and that's why we don't take this trade. So there's a clear imbalance here, because betting on a sure bet, let's call it, or a more likely to happen thing here leaves us conservative, while here we say in case of losing, well, who cares? I mean, that's just whatever such a ticket might cost. Still, one thing, it's okay, and I have to admit I'm sometimes a victim of this, because I to some extent love to gamble in these instances and say, well, let's just give it a try. And this is the thing, I do this mainly because of the so-called asymmetric risk reward profile we see here. So in case of, let's say I put up, let's say 5 euros to make 1,000, that's okay. I can live with that. And even if I'm losing the 5 euros, or if it's 50 euros, well, fair enough. If I do this often enough, and at least once I hit here the jackpot, fair enough. Let's now put this differently. And there's one thing which we should avoid under all circumstances. And this is here. This is the case of losing, the so-called sunk cost fallacy. But this is something we will talk about after here, the case of losing and the high probability bet. So there might be a 30% chance of losing part of the accumulated gains. That's the fear of the losing pain instead of going for the profitable bet, respectively trade. So as I already pointed out, this is the other side of the coin, but it's still the same coin here. So you say you overestimate the chances of the trade being unprofitable. That's the reason why you take it off, because you can't stand the 30% chance and the loss which might happen based on that. And that's why you want to avoid it under all circumstances, because it's just, yeah, probably it's scratching your ego to some extent. Who wants to be wrong on a trade or on an overall idea. You have to think big in this case. So think big means you have to think on a more than one trade. And then there's the bad thing. It's the 90% chance of losing 1,000 euros here. And then the hope kicks in, and this says, well, hopefully markets will turn around and the trade just won't be a loser. That's one of the reasons, for example, why former support becomes new resistance and former resistance becomes support, because you can see this happening quite often. And when we're looking at the market, same is also true. Remember the last week or the week before, I think, on the WeWeb, we talked about volume weighted average price, and here on the anchored WeWeb principle. It's based on cognitive biases. So it's the same idea which we see here, because people say, well, I'm in this trade now. I see the market dropping. I'm long. The market's dropping. But I say, well, just turn around once. Just hit the break-even point once again. I'm out then and everything's cool. But I just want to get out break even. And this is very bad, because you will never, ever enter the trades once the market dropped already that much. But now, you're in the trade and your decision is completely different, because now you're emotional about the trade because you're in a losing position. And that's why you want the market to do something, which will probably never happen. And if it happens, you just got lucky on this one. And this is definitely something you have to avoid under all circumstances. So I'm getting here, case of winning, not betting on the breakout, you can still be profitable, even though the big players, the very successful traders, they have no problem with doing that. They are also willing to take some riskier bets here, low probability bets with have at least an asymmetric risk reward profile. But profitable traders, successful traders, avoid here the sunk cost fallacy. So the concept of I've already lost so much, doesn't matter if I'm not losing 900 or 1,000. So in fact, it's the same as the game before. They avoid this under all circumstances. So they cut the losing trade short. In addition to that, it's not just that you avoid a bigger loss in your account, but also remember the pain you feel once you're in a losing position and you just see the market not doing what you expected it to do, and how much mental capital is tied to the trade. And you have to think about this and missing out on other very profitable trading opportunities. So this is one of the reasons why you can not just sleep better, but also trade better after you cut these losers out. This is also a quote from Jesse Livermore in his book Reminiscences of a Stock Operator, by the way. So I'm here about he hasn't thought about the trade anymore after he was out of the trade. So it might hurt at the first glance, but believe me, if you cut out the losing position, it's like you're freed after that, and you can think clearly, you can trade better, and you will trade better. This is a promise I can make. So so now let's come here to how to profit from this. So this sounds probably very interesting now, but still you want to know how to profit from this, but we have to hurry up. And I just realized that the time is running out. So just imagine the following: you have a winning streak, you gain self-confidence, and you feel invulnerable. I made it this example with 30,000 entering Bitcoin, now seeing the markets doubling within months. Now, what you need to do is what I do, let's put it that way, I recommend you doing is induce rational thinking here. So that means try to find actively reasons why the next trade could fail. This is what we refer to as so-called pre-mortem analysis. That's, by the way, one of the reasons why someone who knows about these cognitive biases, for example, in his trading and dissonances, why he will never ever work without a stop, because he does this beforehand and finds out, well, I might have a great trade hypothesis, but still it might not work out. So that being said, I have to place a stop. I have to have a clear point where I know I'm wrong on the trade, and that's why I exit the trade. This is definitely one very important aspect to take out of this webinar here. So, and I bet, in fact, if you do this accurately, you will never trade without a stop anymore, as I pointed out here. You won't fear losers anymore, because it just can't happen. The market will do whatever it wants to do, and we're just playing the rules the market gives to us. Let's put it that way. And in addition to that, we played a little around with the concept of expected value. If you grasp this concept, then what you can also see quite clearly after thinking about it a little while, that if you trade based on cognitive biases, that you will naturally see bad results happening in the long run. And these bad decisions and bad results resulting out of trading based on cognitive biases, letting winning trades run too short, cutting losing trades not at all, but let them run on the other hand, and then accumulate, tie your capital capital in this case, for example. It massively increases your chances of going broke. And the solution here is formulate a trading plan, not just a plan based on a strategy, but also a routine you follow. So a clear idea then what you plan to trade, why you plan to trade it. Know that what you do is tested, it's proven profitable. So for example, you have a trigger event like an earnings release from Apple, from Amazon, from Starbucks, whoever just reported earnings, you know, this or that stock, for example, is hot. That's why I try to see whether I can capture some meat here, one on the up or on the downside, or respectively on the long on the short side. I have to know, once I can consider this title to be hot, for example, and then take it from there. You have to test it first so that you know that it works. This is crucial, certainly, because it gives you confidence in what you're doing. And if you then have a robust approach, take it from there. So the thing is, what it definitely reduces once you know you're trading with a positive expectancy is that your risk of ruin, your risk of going broke with your trading is close to, if not zero. So this is definitely something which is also giving you further confidence. You know, if I follow these rules and if I have a clear risk money management plan, it's not just that I'm mentally stable, but in addition to that, I also know I won't bust my account. I probably will lose some money, fair enough, but at least it will be amount which does not affect me at all, and I can continue to make good trading decisions. And then one final aspect here: stop fighting writing your strategy, respectively your trade. So have a trading journal. Most people don't have a trading journal to avoid, in fact, to get a result which shows them that what they're doing is not working. And the trading journal just tells you the truth. If the equity curve is dropping, upper left, lower right, well, this is a clear sign you're losing money. If this is happening, change something. If you don't change something, you continue to lose money. People want to avoid this and don't look at this anymore, but they just continue to trade. They want to avoid the confrontation with what they're doing is not working. And this is something which then is also showing the difference between a winning trader and a losing trader, because the winning trader has a growth mindset. He says, well, I might have lost on a trade. I might have lost the last month or the last quarter or whatever, but I clearly know that there's a chance to tackle these issues in my trading and to grow from there, to increase my overall profitability. The losing trader says, I cannot change, I will not change, it's just that I'm a bad trader. And this is the big difference between these two. And the trading journal is the is the starting point. You know what works, and then take it from there. So this is the summary now. Psychology in trading plays a crucial role, and here emotions come into play. As I pointed out, anger, frustration, fear, self-confidence, motivation, actionism, and all that, as I pointed out. So this is definitely something to keep in mind. They follow us everywhere we go with our trading, and the resulting emotions then result in cognitive biases, systematically and flawed tendencies here when it comes to percipience, remembering, thinking, and judging, which impacts your trading in a negative way. This is definitely something you have to be aware of. It's not that it's possible to avoid this. That's not possible, because we are humans. We're human beings. Emotions is what we are. So that being said, be aware of these emotions, and especially these resulting cognitive biases in your trading, and develop techniques then to minimize their impact. So on your trading in general, but also on your overall life. This is also something I probably want to give you here on your journey. For example, find actively reasons why the next trade could fail. Formulate a trading plan. Have a trading routine you follow. Have a clear routine you can check, a checklist if you want, at the beginning of the day. It takes some time, but once you follow this, you will see that you follow a clear plan and you are very sovereign here in your overall doing, and you know what you're doing all the time. It's a very abstract environment in which we find ourselves when trading the markets. If you follow routine, you're one step ahead of the crowd, and this is probably giving you already one small edge, but it gives you an edge, and this is something you can capitalize on. And stop fighting writing your strategy. First of all, trading journal is the place to be, where you should start. Every professional has a trading journal, and this is exactly what you should have. And this is then where you can take the next steps from. And so I'm sorry, because it's now 4 p.m. here in Germany. So next time, Wednesday, we'll talk about Bitcoin again, and let's trade crypto. What's the best way to trade Bitcoin and others? We want to give a short introduction again to what's cryptocurrency, especially what is Bitcoin, what's the blockchain technology. But then, and we want especially focus on ways to trade crypto. And I not just give you some thoughts on how to trade Bitcoin, for example, but also some interesting stocks in this context who are directly positively correlated to a Bitcoin. Some of you have heard about Coinbase. Some of you have probably heard of Mara. Some of you have probably heard about MicroStrategy. Some of you have probably heard about Riot. And we'll dig deeper into this in the webinar next Wednesday. London, 2 p.m., 3rd of November, 21. And head over to admiralmarkets.com for further information. Register there for the webinar. I really appreciate if you have the time to join me there. Here are the contact details for further information. Here's the risk disclaimer. Please read it carefully. And one very important aspect, at the end of the webinar, now there will be the survey, and we'd really appreciate if you take the 3 minutes, probably 4, to answer the question there, to give us a feedback and let us do things better in the future. And so that's it from my end. I wish you a nice weekend. All the best. See you next week on Wednesday. I really look forward to it. All the best. Bye-bye.